In this lesson, dual candlestick patterns, the learning objective is you should know the different dual candlestick patterns. The market mechanics for dual candlestick patterns are the same as single candlestick patterns. This is because if you combine dual candlestick patterns, you would get the single candlestick patterns. The first type of dual candlestick pattern we are going to look at is the dark cloud cover. The first candlestick in this pattern should be a strong up candle with small shadows. Due to the market upside momentum, the next trading period opens above the highs of the last candlestick. But then, bearish pressure totally overcomes the bullish move and negates all the hard work done by the buyers, pushing prices lower. The perfect dark cloud cover has the closing price of the red candlestick below the middle of the green candlestick, as you can see here. The open price of the red candlestick should be above the highs of the green candle. This is a bearish reversal pattern and usually it appears after some upside move on top or under resistance levels. This pattern gives you an early indication that the market has reached some resistance and could bounce to the downside or even reverse for the long term. This pattern is a reversal signal, but it should be ignored if it does not occur after an uptrend. The bullish version of the dark cloud pattern is the piercing pattern. Piercing patterns appear after a strong move down and could mark a bottom or appear at a support level. This pattern could give you an early warning about a possible upward retracement or bullish reversal. The first candlestick should represent a good strong down candlestick with small shadows. Due to the market downside momentum, the next trading period opens below the lows of the red candlestick. But then, bullish pressure totally overpowers the seller's moves to push prices higher. The perfect piercing pattern assumes that the closing price of the green candlestick should be above the middle of the red candle. The opening price of the green candle should be below the lows of the red candle, as it is on the picture. This pattern is a reversal signal, but it should be ignored if it does not occur after a downtrend. There are two types of engulfing candles, like all the other patterns. There's a bullish one and a bearish one. Bullish engulfing patterns are very similar to piercing patterns. The difference is that engulfing patterns are more powerful. In engulfing patterns, the body of the second candlestick totally engulfs the first candlestick instead of just closing at the middle. Here are the two examples. Bullish engulfing patterns show that sellers are totally overpowered by buyers, while during a piercing pattern, the buyers only have the power to return the price into the body of the previous red candlestick. The greater the difference between the first and the second candlestick, the more powerful the engulfing pattern. In the perfect engulfing pattern, the body of the second candlestick totally engulfs the first one, including the shadows of the first candle. Here is a perfect example. As you can see, the body covers both the shadows and the real body on both sides. Also, the market should create a lower low if it's a bullish engulfing before going up, or a higher high for a bearish engulfing before going down. But in the real world, often the body of the second candlestick engulfs only the body without shadows of the first candle. The trading range of the second candlestick should be greater though, because if the bodies of the both candlesticks are almost equal, then the engulfing pattern is weaker and it could lead to sideways price action and not a reversal. If an engulfing pattern appears after a doji, this makes it even stronger. That is one of the single most trading patterns to look for, because a doji means that there's a pause in the price movement, and then if you couple that with a engulfing pattern, it shows the direction that the new trend will lead. The pattern is valid if the market closes above the high of the bullish engulfing pattern. What this means is that the second candlestick really needs to close above the engulfing pattern. The Harami pattern is the opposite to an engulfing pattern. It has a big first candlestick and a smaller second candlestick. The small candlestick can also be a doji. This is called a Harami Cross. As a potential market reversal, the Harami pattern is a sign of consolidation in the market. It implies that the market can reverse, and traders may need to wait for a confirmation before deciding to buy or sell. The Harami pattern tells us that the previous tendency of the market is becoming weaker. Harami patterns can appear at tops or bottoms. Bullish Haramis are often red-green. They appear at the bottom of a downtrend with loads of red candlesticks, then this candlestick, then you have the green one. This forms the Harami pattern. And for a bearish Harami, you would have many green candlesticks, then this small red candlestick, and this would be the Harami pattern. Usually the Harami pattern should have the second candle in the middle of the first one, but what could happen is the smaller second candlestick closes in the upper half of the first one, forming a high price Harami, or in the lower half of the first price Harami. So, if you are looking for a very good indication that the price will reverse from a downtrend, you should look for a high price Harami, where it closes in the upper half of the previous red candlestick and is also green. And if you're looking for a good confirmation that there's going to be bearish reversal, you should look for a low price Harami, where the red candlestick closes in the lower half, while the whole second candlestick is in the lower half of the first green candlestick. If the trading range of the second candlestick stays inside the body of the first one, the Harami is more reliable and has more probability to reverse the previous tendency. The smaller the shadows and body of the second candlestick also mean that the Harami pattern is more reliable. The Harami Cross pattern has greater probability to temporarily stop a previous tendency than an ordinary Harami. Just as a reminder, the Harami Cross is a big candlestick. So in a downtrend, if you see a red candlestick then a doji, that's a Harami Cross, and a bullish one. Another common dual candlestick reversal pattern is the tweezer patterns. This type of candlestick pattern usually occurs after an extended uptrend or downtrend, indicating that a reversal will soon occur. A key point for tweezer patterns is to have the same highs and lows. Tweezer tops usually can be seen after a solid uptrend, and in a downtrend you can find tweezer bottoms. It's better if the candle is the same as the previous trend, so in a tweezer top the first one should be green, and in a tweezer bottom the first one should be red. And the second candlestick should be the exact opposite, being the other color but mirroring the structure of the first one. But this is not necessary. The size, shadows, and top/bottoms should be very close to each other. That is the most important thing. It doesn't have to be perfect, but as close to perfect as possible would be best.